Welcome to this week's edition of Trade the Trend. I'm Jason McIntosh. It is Friday, the 24th of June, 2022. Today, I'm going to be talking about the SP 500. I'll be telling you about the downside risk, and I'll also be telling you what I think it's going to take to turn the market around. And I've also got a fascinating graph for you. I think you're going to love it, and I think the outlook that this suggests is going to surprise a lot of people. So make sure you stick around for that. As always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's jump into our first chart. So here we go. We've got the S&P 500 on the screen. And I think with the markets sitting just above their lows for the week, I think the markets remain on high alert across the US markets generally. Now, I'm going to come back to this in a moment, but first I want to show you a graph. I want to show you a chart that turned up in my Twitter feed through the week. What this does, it plots the yearly performance of the US market going back to 1928. So each of these lines is 1 year's performance in the US market. What we have here, this red line, this is where we are in 2022. So as you can see, it is one of the worst years in history, with the exception of this one down here, which is 1932, which was the tail end of the great crash of 1929 and taking the market into the depths of the Depression. This is really up there with the worst of them. There are a couple of others nearby which are of similar downside magnitude. They were back in 1962 and 1940. But really, I think you've got to say that this is a sell-off of historic proportions. And I think looking at a graph like this, it does put some perspective around what's been going on. So if your portfolio has been hurting and you found this a difficult period, well, it's a good reason. You're here with one of the worst periods in history. And it's also evident in the stats, the statistics. So from the March high, the S&P 500 has been down. So from this high here in March, the S&P 500 fell 10 out of 11 weeks. And I believe that's the first time that's happened since 1970. So really, this has been one of the nastiest sell-offs in decades through this period over the last 6 months. Now, as I said, I think this market still remains on high alert. And what worries me with the US market is this cascading pattern, which I was telling you about last week. So let me just quickly draw that in for you. So what we've got with the cascading pattern, it's that you can see that as time has been going on, the rallies have become shorter and the sell-offs have become steeper. So that creates a cascading pattern. I spoke about that a lot last week. So if you go back to last week's video, if you didn't watch it, I'll give you a lot more detail. I'll give you some examples in that. So this is the risk with the market at the moment, and we're seeing the same pattern in the Nasdaq. So we quickly jump to the Nasdaq. You got this same cascading pattern, and the bounces in the Nasdaq have been even weaker than the S&P 500. So this market is particularly struggling. And also when you go to the small caps in the Russell 2000, you got this same cascading pattern. And where we are here this week, well, we're looking at the Russell now. This is such a small bounce. It's barely budging off its lows. And whilst these indices are below their 100-day and their 50-day moving averages, I think they remain particularly vulnerable to a capitulation style sell-off. So just going back to our S&P 500, so a capitulation style sell-off would potentially see a rapid decline down towards, perhaps 3,200 or thereabouts. Now, I want to show you an example of a market that currently is unraveling even more so than what we're seeing in the US. Just gives you an example of that cascading type motion that I'm talking about. So this is the South Korean market. So if we go over to this, here are our COVID lows in March 2020. This market peaked earlier than the US market, peaked in July 2021, which is around the same time the Australian market peaked as well. And what we've seen over the last couple of weeks, we've seen the market really like roll over into that capitulation style sell. And this is exactly what we don't want to see happen in the SP 500, because then that drags down the markets globally. Really, it has that flow-on effect into the European markets, into the Australian market, the Canadian market, all the developed markets would then, you'd expect, continue to see that sell cycle unfold. So that's the risk. This sort of pattern through here, and then another decline. So if we go back to our S&P 500 chart, and let me just draw in on this, a sort of pattern that we've just recently seen in the Korean market, which we'd ideally not be seeing in the US markets. So it's some sort of a flagging formation that fits in around, like, you never know how these work out, but this is a typical sort of flagging formation that develops, and then you can get a decline from it. If we start seeing this price action over the next week or two, where the bounce can't gain momentum and it sort of sits along the bottom of this where we are now, if it just sort of like trundles sideways to slightly up, the risk is that we do get that rapid decline from the pattern. So that's by no means a prediction of what's going to happen. It's simply pointing out the sort of price action we want to be watching for, because that will give us potentially a warning that this sort of decline could be close at hand. So we want to watch for that. We want to watch for that over the next few days, over the next week or two, and see how that develops. And I've been saying for a few months that the game really shifted to defense back in late February, when the Nasdaq broke down out of a big trend channel. So we can even just quickly put that up on the charts, just as a refresher as to what that was. So we had this. Let me quickly line that up. Had this trend channel in the Nasdaq, which had been in place since around October 2020. When it broke down here, this was actually, it was late January. We started to get the breakdown. That was the sign. That was the warning sign that we wanted to go on defense. And if you've been watching the videos, you'd be across that, because that's been the ongoing theme over the last few months. And a big part of this has been, don't buy the dips. Don't buy dips in stocks which are trading below their moving averages, because they've been the most vulnerable, and that's where we've seen the biggest losses during this decline over the last few months. And then exiting stocks that are trending lower. So with my Motion Trader service, I've got trailing stop losses and exit stops that help members know when to get out and help them get out, rather than holding and hoping that a stock's going to rebound. So having that disciplined exit strategy can make a big difference in avoiding the losses which have been occurring through this period. And I think that's the best way to mitigate the risk of a further deterioration in this market. So how can this market turn around? What's it going to take to turn this market around? Well, I think that to do this, let's jump over to a 4-hourly chart, because these are good, because they give you finer detail as to what's going on. The section I'm going to focus in on is this part here, this last leg of the decline. That's what we want to look at on the 4-hourly chart. So here we have it here. So you can see the still captures, there's a high from January, and just gives us a little bit more detail through this section here. So what I want to do, let's start by putting on the Fibonacci retracement levels. So when we do that, we get our Fibonacci band between around 3,800 and 3,000, just below 4,000 really. The market's coming up, getting close to there as I record this on Friday afternoon Australian time, so before the Friday session in the US. The market is starting to approach this Fibonacci region, which is a natural retrace point, the natural rebound point following a decline. And we also note during this range, we've got a resistance band that comes in at around 3,900 to 3,800 thereabouts, and that captures these previous lows. So we've got like a double resistance area. We've got the Fibonacci retracement region, and we've got a resistance band just above the market. So the first hurdle for the S&P 500, it's can it clear these levels? Can it get through this resistance band? Can it get above the top of the Fibonacci range? If it can do that, well, then I'd expect to see short covering really start to gather momentum. And that's what could propel the market back up towards above 4,000, up towards this previous high at around 4,200. And if that happens, well, that would really break the sell cycle that's currently in play. And it's a sell cycle that's currently in play, which is risking that cascading or that capitulation sell-off, which is very much a risk for the market currently. Wouldn't necessarily mean that final lows in place. If we can break up to here, if the S&P 500 can break up to here, it doesn't necessarily mean a final lows in place. We've then got to watch the price action and how it unfolds from there. But I think it would take the market off red alert, because at the moment, with the market in that cascading setup, it is I think red alert to that capitulation sell-off. So it's I think it's easy to get caught up in the negative frenzy in these times when we have had significant sell-offs in the market, significant losses. And I think it's really important that we need to understand the risks. So that's what I've been outlining in the videos so far. It's been outlining the risks, but we shouldn't be so focused on bearish scenarios that we then go and overlook some of the potential positives. So that's what I want to do now. I want to look at some of the positives which I'm also seeing start to appear in these markets. So let me show you this graph. I think this graph is fascinating. So this turned up in my Twitter feed through the week. And I just love these long dated data series. So this one goes back to about 1987. So it goes back to 1987. That's the 1987 stock market crash. So these long data series are great because they give you a look at so many different market cycles. It's not just looking at like what happened over the last 3 or 4 years. It's looking at a range of cycles and a range of conditions, and that can really help give you a better understanding of the possibilities moving forward. So what this is plotting down here, this is the interesting part. So what this is plotting, it's plotting the American Association of Individual Investors survey results, and it's the spread between investors who are bullish and investors who are bearish. So when we get readings up here, the markets investors are overwhelmingly bullish. When we get down the bottom, well, it's the opposite, of course. It's overwhelmingly bearish. And just look where the market is now. Like, this is almost as low as it's ever been since they started recording this data back in, I think it was back in 1987. It's only the third time come down and touch this blue line. The last time it got down this low was during the GFC. This is the GFC low down here. Prior to that, there was a low in 1990. The market got spooked with memories of the 87 stock market crash. The market started coming off. Investor sentiment got very negative. But look where we are now. Like, where we are now is lower than the market got during the dot-com bust. This is the dot-com bust through here. So this is particularly negative sentiment. And as we can see at other times where sentiment got extremely negative, it did mark a low point in markets, and then markets went on and ultimately made new highs. Also, of course, down here, the the dot-com bust low. Didn't quite get to the same level, but had the same impact. Overly negative sentiment led to a period of strong prices. And all these points down here, it's the same effect. So that's a positive. That's a positive which is developing in the market at the moment. It doesn't tell us where a final low is going to be, but it tells us that we're in the territory of where final lows can be made. Now, if you're getting value from this video, please hit that like button. It tells YouTube that people are watching, they like it, and they show other people. And also, please leave a short comment. Just, hey, Jason, thanks for the video, because that also tells YouTube people are engaging, and then YouTube's more inclined to show other people. And please hit that subscribe button, because it really helps me get my message out to get my videos out to a wider audience. So if you could do that, that helps me so much. So yeah, if you could please do that for me. Like, subscribe, and a quick comment. And also, if you haven't already, jump over to my Motion Trader website. So what I do at Motion Trader, I use algorithms to analyze over 2,000 ASX stocks, and it's all about trend following. It's using trend following techniques to identify trends in markets, then using risk management to let profits run, cut losses when trends roll over and start to fall, protecting capital in the down periods like we are now. If you're interested in all that, lots of free information on the website to have a look at the resources, learn a bit about how I operate in the markets, where I get to pass on my experience to you. So come over and have a look. So okay, let's get back to where we were. So I'm going to tell you about another positive I'm seeing at the moment, and that is some of the market breadth indicators are now starting to rebound. So I'll show you one in particular, which is of interest at the moment. And it's this one here. It is the number of stocks above their 20-day moving average. And what we've got here, you can see it's just starting to rebound. Let me give a little bit more data on this. And what I'm also going to do, let's overlay this with a chart for the SP 500. Okay, so here it is here. Now let's just do a little bit of resizing. So we've got a good view of all this. Okay, so let's just have a look at this. So look at these low points. This is when there's almost no stocks above their 20-day moving average, when the market has been falling. So it's going poor market breadth. And every time the market gets down here, we get some sort of a notable bounce. It can either be a lasting low, or it can be temporary lows before further declines later on. But they all coincide with some sort of a low in the stock market. It's been particularly useful just through this period here. Like I've used it to help identify the rallies we had in March, and then recently in May, all coincided with lows in this indicator. Look where we are now. We've been at extremely low levels, and we're now starting to rebound. So we're back up here now, and the market is starting to rebound slightly. So this is interesting. This is a potential positive. So if we can continue to see this indicator of market breadth improve, that's likely going to see a continued rally in the SP 500, which then could be the catalyst to breaking that sell cycle that I've been speaking about. And then if that gets neutralized, then we get to assess the price action, see how it stabilizes. Doesn't mean a final low's in place, but it does help negate that risk, the capitulation style sell-off. And look, as I said last week, there are aspects of this sell-off that are unprecedented, and we shouldn't overestimate our ability to predict how this is going to play out. But hopefully by having an understanding of some of the potential scenarios that we've been talking about today and in previous weeks, hopefully that puts you in a better position to make less emotional decisions, because that's what costs so many people so much money, particularly in these periods. And hopefully it at least helps provide some framework to the uncertainty that we're seeing at the moment. So hopefully these videos are helping in that respect. Now I am experimenting with a shorter video this week. I want to bring you high quality analysis each week. But what happens, I talk about so many different markets, the videos get quite long. I'm trying to keep them shorter, down around 10 to 15 minutes perhaps. So let me know. I can't get as much information into a 10 to 15 minute video, so maybe I make a couple of videos each week. Let me know. Let me know what works for you. Let me know whether you want to be able to consume this information quickly, or whether you like the longer format where we cover more markets, or whether a couple of videos each week would work better for you. Let me know in the comment section below. It'd be really interesting to read what you think, and then I can evolve this channel to help you as best I can. Let's call that a wrap for this week. Thanks for joining me. Look forward to coming back next week and talking to you again. Until then, bye for now.